Hello, I'm Kamal Santa Maria. This is Counting the Cost on Al Jazeera, our weekly look at the world of business and finance. This week, QE2. Nothing to do with Queens or cruise ships. It's the United States' decision to print more money, $600 billion to be precise, and why China, among others, thinks it's wrong. Another rising power, India prepares the red carpet for President Obama, but just what is America's chief salesman selling to the subcontinent? And we look at South Korea's rise to the G20 table ahead of the group's next big summit in Seoul. So let's kick off in the US, the economy that affects all others almost without exception, which is a pretty serious situation when unemployment's running close to 10%. There's a serious threat of deflation, plus continuing weak growth. So what to do? Well, if you're the Federal Reserve, you take immediate and drastic action. How drastic? $600 billion worth of drastic over 8 months. That's how drastic. It is a big move. And this week we'll look at the new stimulus plan from all sides, beginning with this from Kimberly Halkett in Washington, D.C.
It's the Federal Reserve's big gamble. It's called quantitative easing, a fancy name for trying to boost the ailing U.S. economy. One day after elections that were all about cutting government spending, the independent central bank, the Federal Reserve, is out there doing just the opposite. It's buying up $600 billion in Treasury bonds or government debt.
The Federal Reserve tried quantitative easing once before during the Great Recession of 2008. It spent $1.7 trillion between then and early 2010 in the hope of providing economic stability. Well, it had mixed success, but now the Federal Reserve is at it all over again.
Here's how it works. The Fed buys bonds or debt from the banks, providing them with cash to loan consumers. Buying so many bonds brings down already record low interest rates even further. It's hoped these low rates will push consumers to borrow more money or shop for a mortgage and stimulate the struggling economy. The move could weaken the already frail U.S. dollar and will make the U.S. government further beholden to international governments financing its debt. It will also mostly lead to higher domestic inflation as more currency is printed virtually out of thin air. So why is the Federal Reserve taking such risk?
Anytime you do a $1.5 trillion new experiment in a fragile economy, there's an element of risk, I think it would be fair to say. The fact that we're going to add another $600 billion to that over the next 3/4 of a year doesn't make that risk smaller, it makes that risk larger.
But as the Federal Reserve attempts to once again revive a sputtering economy, it's up to interpretation if the decision to print more money will hurt or help.
Okay, so Kimberly gave us an idea there of how quantitative easing should work, but there's no risk in over-explaining something like this, especially when it just looks like the government is printing money. Take a look at this. This should explain it. The Federal Reserve pumping $600 billion into the economy. It does so by buying bonds and mortgages from banks and corporations. This much we know already. They, in turn, are supposed to lend the money out to businesses who use it to grow and therefore make more money, and that money then heads back to the government in the form of course, taxes. Simple, right? Actually, no, because the banks and corporations are being accused of holding on to money from the sales of bonds, and it's just sitting there while businesses still struggle and the government doesn't get its money back. So how else could it work? Behold the Chinese version of QE, which some see as a better option. There, they pumped almost the same amount of money into the economy as the United States did, but instead invested it directly in new road and rail projects, infrastructure. The companies building these projects, they hire more people, they pay them from the government money. Then those people pay the government back, again, through taxes. But the key here is that you've removed the middleman who could potentially hang on to that money. So we've got different versions there of essentially the same concept, but which is more likely to work? A few weeks ago here on CTC, we spoke to Professor James Galbraith from the University of Texas in Austin. He gave us some great insight into the US economy. So we've brought him back to see what he makes of quantitative easing too. Professor, thank you for coming back. It's happened now. They've gone big. Another $600 billion worth of stimulus. Is it the last throw of the dice for the US?
I don't think we're going to see any material effect from the Federal Reserve's action. It will boost the carry trade. The banks will be lending the money out to emerging markets with higher returns. There's some reaction to that already from South Korea, which is threatening to impose capital import controls. But in terms of consequences for the American economy, it's difficult for me to see what it is, to understand what it is that the leadership at the Federal Reserve has in mind. Maybe there would be some money moving into the stock market, but do they really think that the entire American economy is going to suddenly start being buoyed up by a small rise in the stock exchange? If the whole thing is implausible, it strikes me as a move that you make when you have basically no other options and you want to appear to be doing something.
So, if you're right, and this doesn't work, then what? I mean, neither of us has got a crystal ball. No one's got a crystal ball to look into the future, unfortunately. But if this doesn't work, what could the US Fed possibly do next?
Well, the economy will be stabilized, as it always is, by the enormous federal deficit, which occurs simply because when people lose their jobs and their incomes, they stop having to pay as much in taxes. And that is what kept us out of a true free fall in a Great Depression. And it will keep us going, but it will not restore strong growth, and it will never restore high employment. So we're looking at a period of drift, fundamentally, in which the population will get poorer, will experience considerable ongoing hardship, and will no doubt get angrier.
Okay, Professor Galbraith, wait there for a moment for me if you would, because I think we should hear from the President himself on all this. It was interesting listening to his briefing after the US midterm elections the other day. What he said about other countries and the way they were spending stimulus money. Have a listen to this.
I think the proposal that I've put forward with respect to infrastructure is one that historically we've had bipartisan agreement about. And we should be able to agree now that it makes no sense for China to have better rail systems than us, and Singapore having better airports than us. And we just learned that China now has the fastest supercomputer on Earth. That used to be us. They're making investments because they know those investments will pay off over the long term. And so in these budget discussions, the key is to be able to distinguish between stuff that isn't adding to our growth, isn't an investment in our future, and those things that are absolutely necessary for us to be able to increase job growth in the future as well. Now,
so, Professor Galbraith, would that have been a better idea in the first place, for the US to put its money directly into something concrete, literally concrete, infrastructure, like the Chinese have done, and see some actual results that way?
Well, you would get some additional employment, but the most important thing about that strategy is that you would begin to rebuild the country. You would set a strategic direction which would begin to motivate private businesses. They would see an avenue for productive and profitable activity. And you would begin to deal with some of the serious longer-term problems that we face as an economy and as a society.
Okay, let's just change tack briefly, look at the political side of things. Obviously, there was a major shift in the balance of power this week, the midterm elections in the US, the Republicans taking back the House. In your view, how is this going to affect the way the United States moves forward from here? Are we going to see even more blocking, even more often, of such stimulus expansionary plans?
Well, they have been blocked for some time. I think there are a couple of things. We'll see later what happens on the tax front. It would not be unimaginable that part of the blockage would lead to the full repeal of the Bush tax cuts, and the next Congress would then have to examine the consequences of that for the economy. It's possible that that we'll see a clearer debate over Social Security and Medicare, and that the result of that will be that those programs will be protected from the ongoing campaign to cut them. I think that would be a very desirable outcome. So I'm not entirely negative on gridlock. It will be a very interesting challenge for the incoming speaker, Mr. Boehner, to bridge the divides in his own party and to function effectively as a responsible official of the government. And we will see there will be a great temptation to stage dangerous political theater next March when the debt ceiling comes up for renewal, and we will see how capable the Republican Party actually is of making the transition from a loud, rather incoherent opposition into a majority party in the House.
That is Professor James Galbraith with us again on Counting the Cost from the University of Texas in Austin. Thank you, Professor. When Counting the Cost returns, we talk to Egypt's Minister of Trade and Industry about currency, economic growth and IKEA. Plus, one of the world's emerging economic powerhouses, it's India in focus ahead of a US presidential visit. Welcome back to Counting the Cost, your weekly business stop right here on Al Jazeera. So we compared the United States and China in the first half. I want to introduce another country now, India. Not so much on the fiscal side of things, but trade, because these are all very important players, these three. If we have a look at the numbers, the way it compares, two-way trade, this is China and the US in 2009, around $366 billion, so it's pretty healthy. Indo-American trade only at $37.6 billion. Remember though, China and India have around the same populations, but India's economy is just a quarter of the size, so there is clearly huge untapped potential. You may also remember the US and India signed a nuclear deal earlier this year, and on top of that, the US wants the lion's share of India's defense deals. And guess where Barack Obama's headed next? Prerna Suri has more from New Delhi.
There's a new confidence on show in India, and that includes its armed forces. Suddenly, it seems India has become one of the most important destinations for the world's top military salesmen. That's because Asia's third largest economy is planning to spend more than $30 billion over the next 5 years, overhauling its mostly Russian-supplied weaponry. And improving both business and defense ties will be one of the key challenges facing President Obama, who's paying his first visit to India. The United States is looking to beat off competition from France, Russia and Sweden for those billion-dollar contracts. India is in the market for around 120 fighter jets and up to 10 Boeing C-17 transport aircraft. With the United States economy still stalled, the deals couldn't come at a better time for President Obama. And one expert is predicting the United States is in a strong position.
They've signed up agreements worth about $12 or $13 billion. And there are agreements worth more or less the same amount in the pipeline. And then there is the $10 billion deal for the multi-role combat aircraft. So American business and American economy stand to do very well out of India.
Defense cooperation has become an important feature of relations between both countries. The United States has held more military exercises with India than any other country. In return, the government here has bought American military hardware in the past 2 years worth over $2 billion. But while Prime Minister Singh looks more favorably on Washington, there's still skepticism on how much one visit will alter the power play between the nations.
I don't see too much happening in respect of either India-United States relations or the AFPAC agenda, the Afghanistan-Pakistan agenda of the United States, which is related to the India priority, as it were.
So as the world's two largest democracies come together, the challenges will be plenty. Jobs and the economy will be President Obama's priorities, while for New Delhi, it would like more engagement on security and strategic issues. The success of this visit will be determined on how best these two different needs can be met.
And after that trip, there's the G20 to think about. South Korea is hosting this time, a reflection of its growing economic and diplomatic confidence. In only a few decades, South Korea has leapfrogged other countries, building its economy first on things like manufacturing, heavy industries, and then more recently on technology and services. Steve Chow has more on that.
On the docks of South Korea's southern port of Ulsan sits the country's latest products for export. Several football fields long, these massive container ships are the largest on the high seas. And Hyundai, better known for its cars, fashions one of these for its customers every 3 days. Its shipbuilding enterprise, stretching 5 kilometers long, is by far the world's largest and most profitable.
You can see there are big signs just off there. The title can be translated into English. When we are doing well, our entire Korean nation is doing well.
It is these massive engines of industry that have made South Korea the economic powerhouse it is today, and Koreans themselves have benefited. The average salary for a shipyard worker here, around $60,000 US.
Everywhere in Ulsan are reminders of the role of big industry. 1 in 10 people here are employed in various Hyundai ventures, including the world's largest automaking plant. Thousands of its vehicles are rolled out daily to destinations the world over. Just 40 years ago, this metropolis of more than 1 million was a poor fishing village, population 200. And while the fishing tradition remains, most have moved on to more lucrative trades. Kim Song-dan made his millions as a banker.
The change in the quality of our lives is beyond anything I can describe. It's beyond words. And we really have companies like Hyundai to thank for this.
Loyalty to the country's brands is credited for keeping South Korea's economy moving, especially during recessions. On the streets of Ulsan, there really is only one brand to drive. And want to do some shopping? Try the local Hyundai department store. But wealth hasn't flowed through the country evenly. Up the coast, Gangneung County was once a thriving port of commerce, but it never managed to attract big business. And when the fishing industry collapsed, so too did the area's fortunes.
It is sad we missed out on South Korea's economic prosperity. And it may be too late now, but all we can do is try and catch up.
Gangneung is trying to catch up by selling itself as a tourist spot for those seeking fermented seafood, a country favorite, but definitely an acquired taste. Hit by the latest economic slowdown, Hyundai's shipyards are also looking to diversify. Word is some production lines will shift from making cargo to luxury cruise ships, all in a bid to keep one of the world's largest economies steering the right course.
Now, finally, a country we don't often look at, but one which does have an interesting story to tell, Egypt. Easily considered a developing economy, never mentioned in the same breath as, say, the BRIC countries, Brazil, Russia, India, China, but with a whole lot of unrealised potential. Egypt's Minister for Trade and Industry, Mohammed Rashid, was in town earlier this week. We sat down for a chat. He started by explaining how he thinks the country escaped the worst of the global financial meltdown. Minister, thank you for your time. We really appreciate it.
Thank you.
Broadly, how would you describe Egypt's ability to deal with this economic crisis?
Definitely the internal market and the internal consumption was the most significant factor helping us to confront the economic crisis. But I have to say that before we get to the economic crisis, we have been able to stay solid in the face of a financial crisis. And I have to say that this was the first line of defense that we had, which was the reality that because of the reform that took place in Egypt since 2004, our banking system was very robust and we did not have to suffer from any consequences, negative consequences in the banking system due to the financial crisis. But then obviously the economical crisis was impacting anything that had to do with our international relations, whether it's the export or the FDIs or the expatriates, Egyptian expatriates working outside, the remittances or the tourism factor. But as I said, what kept us going and what made us really keep a positive level of growth at more than 4% was the local market consumption.
How is the currency affecting Egypt? Because it's huge. It's a hot topic everywhere about whether currencies are too low, affecting exports and things like that. How is the pound, the Egyptian pound, against the dollar? Well,
the movement of the Egyptian pound have been very stable vis-a-vis the dollar. The government does not interfere in the exchange rate. Of course, the central bank is the one that is setting monetary policies, including the interest rate. It is very complicated, as you just said, to really try to analyze what is happening with all the movements taking place between the dollar, the euro, the Asian, of course, currency situation, which is impacting competitiveness and making an impact on our export and import. 40% of our export is with Europe and trade with Europe, so of course the euro-dollar relationship is also very important for us.
But all in all, I think we are like the rest of the world. We are just struggling with this whole issue of currency exchange. But we maintain the course that we as a government, we do not and we will not be interfering in the pricing of exchange rate in Egypt.
Egypt is in a very unique position, and I mean that geographically, first of all, Arab world, North Africa as well. It seems it could be a perfect, and maybe you tell me it already is, a perfect spot for an economic hub to draw in investment. Now, you said that FDI's foreign direct investments are down at the moment. What is Egypt's long-term plan to turn and use the potential of its location?
No, I totally agree with you that Egypt has the potential and have not been exploited so far. I think the economic reform that took place in Egypt in the last 6-7 years are key to allowing us to really take advantage of such a potential. We have seen our foreign direct investment going from $2-3 billion to $14 billion per year before the economic crisis. It did drop now to about $7 billion, but we are planning very aggressively within the next 3 years to get to $20 billion. We understand that to get there, first of all, we need to learn from the experience of the last 6-7 years, which means that we are going to launch second wave of reforms now, which will tackle some of the areas that we have seen hindering these possibilities. The second point that we need to work on very aggressively, and we started, is to open even more areas for investment in Egypt.
Well, let's just focus on the foreign there. Do foreign countries want to come in? Have you got enough interest, and from where?
Sure, we do. Actually, many people ask the question, what's happening in Egypt now? You have elections, you have, parliamentary election, you have presidential election, how stable it is, what is the social stability factor is like, and the region. We have seen, I can give you just a few examples, in the last few weeks, we have seen some very significant moves from big multinational companies coming into Egypt. Electrolux, the second biggest company in the world producing household equipment, invested $600 million in a manufacturing facility in Egypt. Metro, Macro, the leading retail operator in Europe, the biggest in Europe, have already committed $200 million and started opening up shop in Egypt. IKEA is now moving into Egypt not just as a retailer but also as production. All these things are just happening in the last few weeks. In the middle of all this debate and discussion taking place. Why it is happening? Because people understand that reform in Egypt is moving in the right direction. People see that as irreversible. People understand that the stability factor is there to stay. And people are attracted by the large potential of the local market. Emerging markets are becoming more attractive at the moment. People are not seeing growth in developed countries. People know very well places like China, India, Brazil, but they're looking at the second tier of these emerging markets, and Egypt comes very strongly among that team.
There you go, snapshot of the Egyptian economy there. Don't forget Counting the Cost online. Here's our main page. You get there from the business tab at aljazeera.net/English. We put this episode up there in full. Blogs go there, previous shows, all for you to catch up on. And this is our Twitter page, updates on what's on the show, links to some interesting business stories, and the easiest way to get in touch with us by far, at AJ Counting Cost is the name to look for. But that is it for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team. Thanks for joining us. The news on Al Jazeera is next.